probably heard of working capital, and you might even know exactly what the accounting definition is for it. It's something that when you have it, you don't really think about it, and if you don't have it, you definitely know you need it. If you've ever had to rob Peter to pay Paul, then you probably don't have enough working capital. Working capital is the money that you have for your day-to-day operations, calculated by your current assets minus your current liabilities. Or another way of saying it is, it's your company's ability to satisfy its short-term obligations. I find that working capital is probably the hottest topic in the construction industry, when there's usually a need for upfront capital to get jobs started and going before you can actually finish them and turn a profit. But it's also the industry where I see the most problems with it. A lot of our construction clients work with bonding companies, and they need us to provide some financial information, a compilation, or a review to help get their jobs bonded and limit the need of their working capital. What is working capital? And as an accountant, I'd say that working capital is your current assets minus your current liabilities. But that may not mean much to someone who doesn't have a lot of accounting background. A current asset is usually an asset that a company owns that's highly liquid, something you can easily turn into cash, such as cash itself, accounts receivable, or inventory. Those are the most common types. Current liabilities, on the other hand, are also going to be all of your obligations that are going to be due in a very short amount of time. Things like your trade accounts payable, some short-term debt that needs to be paid back in less than a year, or expenses of that nature. If you take the total of your current assets and subtract your total liabilities, your total current liabilities, then you're going to have your working capital number for use of providing to anyone who's asking for the calculation, such as your bonding company. Sometimes when you do that calculation of current assets minus current liabilities, you may find your current liabilities are greater than your current assets. This would be negative working capital, and it probably means that you have a working capital problem, and you probably don't need me to tell you that. When you have to float your payables as long as possible to make the cash stretch, that's never where a business owner wants to be. And you're usually looking for ways to increase your working capital. Where do you get the cash from? Do you need a line of credit? Do you need to put in a loan from the owner of the company? There's a lot of different ways to increase your working capital, but that's only a short-term solution. Having a line of credit be your only solution to your working capital problem probably means that there's some underlying problem to the way that you're running a company. Maybe your overhead expenses are too high. Maybe your pricing is incorrect and you're not as profitable as you need to be. It's something that you might need help with from a professional in the accounting industry to help diagnose why you're in this problem to begin with. So maybe you don't feel like you have a working capital problem, and you may not. But that doesn't mean it shouldn't be something you know how to calculate or even track. Looking at a trend analysis of how your working capital is changing month to month or year to year may give you a really clear idea on where your company is headed. A good working capital ratio is of course going to be over 1-to-1. That is, that your current assets may equal your current liabilities. The more healthy a business is, the higher your current ratio is going to be. If that ratio starts to decline, it could be a warning sign that something's not right, and you might need to take a look at it in more depth and decide if you need to make some business decisions.